Good morning, good afternoon, good evening. Live from New York, it's the China debate, discussion of the renminbi in 5 questions. Today we're going to talk about whether the renminbi has devalued enough. What drives the renminbi? Is it just about their trade balance in China? What should you focus on more, the yen, the euro, the Korean won, or the ruble? What the CNH is and whether it matters. And what really drives the Chinese renminbi. So, without further ado, let's take the first question. Has the renminbi devalued enough? Or, perhaps put another way, are we just looking at the wrong currency? One of the things that strikes me about the Chinese relationship with the United States has been that it has been systematically trying to depeg from the dollar relationship for over a decade. And it seems to be getting more and more successful. Just looking at this chart, there's a couple of observations that strike me. One is that since 2014, the size and change of the movement in the renminbi, if you look at this, has been dramatically more volatile. So if you look back in the 2008-2010 period, the same period of time, essentially, there was almost no variation whatsoever, which would suggest that you were absolutely pegged to the dollar, which makes sense. During the period of crisis, China reached out and made sure that their currency was as good as the dollar, if not better. It then managed, because of QE and because of its current account surplus, and perhaps because of its growth prospects and interest rate differential, the renminbi saw a steep and steady appreciation. In fact, that appreciation still stands as far more notable than the depreciation of which we've seen since the end of 2014. And while people would say that the renminbi has devalued around 10% against the dollar, answering the question whether it's devalued enough is far more difficult, in part because we're no longer in the same regime. Volatility in the dollar relationship is notable, and there's something else going on. Perhaps, as I said in the first question, we're looking at the wrong currency. The dollar uptrend also has some notable characteristics, which would make me think, if we go back to the 2008-2010 period, that line is somewhere around 6.8, 6.82 against the dollar. We're nowhere near there. Every time we get to 670 in the renminbi, the authorities in China seem to do some intervention. So we're still about 2 to 3% away from that stability zone, which is where I would pay a lot of attention. So what really is the basket of the renminbi that is new, that started at the end of 2014 against the dollar, and why does it matter? The authorities created a RMB Index, in part to get ready for its inclusion in the IMF SDR, and in part to really make a reality of the separation from the dollar peg. There are 13 currencies in the renminbi basket, and it makes clear that the relationships to the dollar and the euro are still very, very important, perhaps overweighted. But if you look at this, just as I was saying that 670 looked really important to the dollar, the same thing shows up in the renminbi basket, implying that we're probably close to a zone where the move up in the dollar that we've seen against the euro, the yen, and the sterling in the last week is going to really put the authorities on the spot next week. And that's something that I'm going to pay a lot of attention to, not just about the renminbi against the dollar and it's likely going through 670, but how the basket trades, the renminbi against the basket, which has large weightings against the euro, the yen, and a lot of Asian currencies. So this currency basket has already devalued 12% over the last year and a bit. That has shown up in a number of ways in China. First, it's shown up in that the sustainability of the trade surplus in China continues to astound and outperform most economists' expectations. So the devaluation has clearly helped exporters in China, which in some ways has helped the growth problem that they've had in the slowdown over the last 3 years. Part one. Part two, the devaluation has really reflected a focus, a shift from dollar and Europe to Asia. And the relationship that seems to be the most important to China in terms of its currency is perhaps the yen, which makes the move from 100 to 104 in dollar yen this week that much more interesting and important for next week. Is the renminbi move that we've seen, this 12%, just about global trade? Is it just about competitive advantage? Is it just about containing their 40 or $50 billion of a month of trade surplus? And is there something else going on here? This picture gets that across. On the right-hand side, perhaps we have the renminbi basket that has the 13 currencies. On the left-hand side, we just have the SDR, which just included, beginning October 1, the Chinese renminbi at the expense of the British pound, at the expense of the euro, and slightly at the expense of the dollar. The SDR stands for Special Drawing Rights, is a global currency alternatives, which really gets us back to the after World War II structure of globalization and how the world works in safety. The SDR is meant to be how countries can borrow from a global international entity like the IMF, and by including the renminbi, it has de facto become a reserve currency, along with the dollar, the pound, the euro, and to some degree the yen. These things are very different than the trading basket that's on the right, which is really the renminbi index. But the renminbi index doesn't even quite capture the trade relationships. When you look at a currency's valuation and whether it is a reserve currency or not, there are a lot of factors to consider. So the SDR and the renminbi index still don't quite get the answer to the question above, which is, what is the renminbi, and is it really just about global trade or about being a reserve currency? Now, hopefully, I'll get into that in the next slide. Here are the weightings of the renminbi index. And you can see here that the euro is just under the dollar in terms of the weighting at 21.4%. The interesting thing here is that the dollar and the euro really are higher weighted in this basket than the global trade would suggest that they should be. So, you know, the US trades around the same as Europe in terms of its share of exports that it receives from China at around 14.5%. This has been consistent through good times and bad times. So there's a little bit more going on here in the renminbi index than just global trade. The other notable thing here is that, you know, suddenly you have the Russian ruble involved here. And the Russian ruble is punching well above its weight in terms of its global trade with China. Also, you see some currencies that aren't included, notably Mexico, Korea, and India, all of which have good trade relationships, but aren't included here. And why? And the index is really reflecting a mix of two things. One is the trade relationships. Two is the actual financial relationships. And that's why you might see an overweight in some of Asia and the Russian relationship, where the flow of capital back and forth between Russia and China is on the increase, and it's a notable thing to pay attention to going into the next 5 years. So the renminbi index is a mixture of capital inflow and outflow and global trade. It makes it a rather confusing way of looking at how the authorities really want to view their relationship and their value of their currency vis-a-vis the dollar and all the other currencies that matter. That makes it a little confusing. Adding to that confusion is the SDR, which is clearly part of the story. So on this chart, we have the BIS currency basket, which really weights the renminbi in both trade and capital flow terms against the RMB basket. And you can see, even if my explanation for the renminbi is index was accurate, it's still not perfect, because the BIS probably is being a little bit more literal in those relationships. And you can see that, again, to pick on the Russian ruble, which is 13 on the BIS basket, reflecting trade and capital flows, it's still number 7 on the RMB, official government basket. So there's some interesting things that are going on in the renminbi index that reflect political realities more than just economic ones. And I think that really matters to how you have to view the SDR. The SDR inclusion is meant to be a political statement by the Chinese that they are a reserve currency available to Greater Asia. And you can see that clearly in the makeup of the renminbi index, as opposed to any other way of looking at things. And I hope that gets across one of the key parts, which is the relationship of the dollar or the yen to the renminbi matters greatly, but the bigger picture for the valuation story of where the Chinese renminbi is going to go is a political one. It is, how does China make the renminbi a more international reserve currency over the next 10, 20, or 30 years? And the index reflects that. So let's go to the next question. What currency pair really matters? I guess I showed my hand that perhaps the ruble is far more important in the future, and the yen is far more important in the present, leaving the euro and yuan to battle it out, sort of a second fiddle against the dollar, which is still very much like the yen in the forefront of the concerns of the authorities in China. So let's go over the yen. This relationship, more than any other, seems to show up in great detail when you listen to Chinese authorities at G20s or other international gatherings, and as they discuss the great devaluation of the yen from Abenomics and Kuroda's BOJ quantitative monetary expansion. From 2012 to really January of this year, 2016, the yen was on a tear, weaker. This was a beggar thy neighbor-like move in the minds of many people in Asia. And the Chinese verbalized that very clearly. And you can see the pain that this devaluation of the yen did to the competitiveness of the China renminbi against Japan. There were a couple of things that Japan really greatly benefited from. One was a flood of Chinese tourists. The rising middle class in China started to go to Japan to buy goods that they thought were superior, from toilet seats to makeup to food. And this continues, but over the last 6 months, this has really turned notably. And one of the slowdown effects that you see in Japan, if you look at their trade statistics and growth statistics, has been the notable drop-off in the Chinese tourist sector in Japanese growth. But I don't want to overstate that. Ultimately, there's clearly in this chart a level of stability that you see that goes back to 2007, where if you look at where we are now in this relationship, between, let's call it 14 and 16, I think the Chinese authorities are okay with where yen is. That makes this move from 100 to 104 in this week in dollar yen a little bit more problematic. And I would expect that the dollar yen relationship move will mean that the dollar renminbi move may follow, albeit at a slower rate of devaluation. But this is something that I'm paying a lot of attention to. You know, I'm not going to read all the statistics, but this was a move from 2012 to 2016 January, over a 50% devaluation, really over a 70% devaluation. It's still, you know, significantly a 50% move from the peak to trough. Let's go on to the next currency. Well, the euro has become, as one commentator would say, a perpetual crisis. Ever since 2008, the euro, which looked like a fine project, likely to surprise everyone in its stability, to have a monetary union without a political one, has proven to be just less important to the world than anyone expected. And that comes quite clearly across in this chart with the renminbi. So what we have here is that the renminbi has appreciated pretty significantly and only modestly has lost 14% against the euro since 2015. It is not really at all where it was in terms of competitiveness to Europe, like it was back pre-crisis, or even in the pre-Greek crisis, or pre-Draghi days of doing whatever it will take, quantitative easing. The euro really needs to either appreciate or the renminbi needs to devalue in order for the market share that was lost by the Chinese to the euro ever comes back. And, you know, I'm looking at this and it seems that we're not yet in that zone of stability, but it may well be that if you do a chart, we may not get there. We may just have changed the paradigm forever in the relationship of China to Europe, and it just is less important. You know, this is something that we're going to pay a lot of attention to, and it makes the ECB taper talk that much more important, and the relationship of its ability to trade, you know, closer to 110 rather than 125, which is where I think the Chinese would feel closer to the 2012 levels, a sense of stability. Let's talk about the currency that they don't talk about, the Korean won. Now, Korea has a very special role to play in the Chinese trade relationship. Korea has actually the largest trade surplus with China. And this trade surplus comes from all sorts of things, partially because the Chinese are repackaging a lot of the exports to the West, partially because some of the Korean goods are just top-notch. Again, I would highlight the makeup industry in Korea. The Chinese relationship with Korea, however, if you look at the Korean won to the Chinese renminbi, that relationship actually looks incredibly stable, if not outright boring. And that tells you something. And maybe one of the reasons why it's not part of the index is that there's no volatility, that they actually think that this relationship is stable and politically sustainable. That's very interesting. I also think that, you know, the move pre-crisis, post-crisis, and this island of stability that we're highlighting is something that suggests that the Chinese authorities aren't so concerned about what happened pre-2008, and that they really are more concerned about what happens from 2010 on. Important to put back into context of the euro relationship, the yen relationship. Well, let's go to the ruble, which, if there's any currency that has devalued significantly even more than the euro, it's the ruble, and perhaps the Brazil real as well. But Russia has a very special relationship to China in that Putin has played the China card, just as Henry Kissinger of the Richard Nixon days pulled the China card against Russia. So the relationship of the ruble to China has been one built on increasing oil and natural gas relationships, on increasing financial ties, where Russia is looking to raise capital in the Chinese financial markets. And all of this stems from the oil crisis and from the Crimean sanctions. The ruble has devalued significantly, and the relationship of trade between China and Russia still is surprisingly small. It's a rounding error against the other 13 currencies in the basket. So when I look at this, this is a currency relationship that is yet to be defined, but one that is highly volatile and makes the RMB index have an oil component to it that perhaps is not unintended. If you held a gun to my head and said, Bob, what is the biggest prediction of where the Chinese authorities want to go with the RMB? It is simply to have energy and other commodities denominated in renminbis rather than dollars. And the Russian ruble is part and parcel of that enterprise and that goal, which could happen as soon as 5 years from now. Why do I say that? Well, the US is becoming increasingly energy independent. And if the US starts to export natural gas and oil, the people that export a commodity generally don't get to price it in their currency. Let's go on to the next question. But before I get there, this chart came from the New York Times, and Malcolm and I discussed this at length, but it's a little confusing, but perhaps worth spending some time thinking about how these trade relationships between Japan, Korea, and China, and where things are built, where the things are repackaged, where things are exported from, and how the currencies matter, all come out very clearly in this chart. And you can see that the relationship between the Korean won and the Chinese renminbi has been really quite stable in this 2012-2015 period. But the relationship with the yen has been incredibly destabilizing. And it makes the relationship of dollar-yen that much more important to the way China views stability in the entire region. Again, I don't want to overemphasize that relationship, but it does look to be the driver of volatility in the dollar-renminbi relationship. And you can see that the world was a lot simpler back in 2000 and 2004, pre the takeoff of the WTO relationship. And the Chinese clearly have worked very hard at their relationship with the Korean won, and less so with the Japanese. This is going to be about the onshore and offshore relationship of the CNY and the CNH. The CNH is the offshore version of the CNY, and it has increasingly become important to the foreign exchange markets. That's where the volume of trading has been. The onshore renminbi and the offshore renminbi have very different roles to play. One, you can buy things only in China with. The other, you can buy things somewhat in China, but mostly it is a store of asset value, and it has become the de facto financial currency unit. So I look at the CNH against the CNY very much like being an old guy with gray hair. You've got to go back to things like South Africa or the Belgian and Luxembourg relationships, where there was a commercial franc and a financial franc, or a commercial rand and a financial rand. The capital differences between flows of capital in and flows of capital out versus things that drive trade and the price of goods that are spent onshore have to be separated in an economy that's just beginning to grow. This gets to the heart of the IMF advice and the general wisdom of the global authorities as they give advice to how China does this incredible shift from being a agricultural to an industrial to a technology, a service-driven economy. And making that change as quickly as they have in less than 50 years in their target is going to be, one of the modern wonders of economics. Already, China should get a lot of credit for lifting as many people from $2,000 a day subsistence to over $6,000 or $7,000 a day, with many people making multiples of that. They've lifted and created a middle class that is the largest in the world. And this is something that I think gets lost when we discuss currencies, but it becomes really important when you start talking about capital flow and about the future of whether China should be a reserve currency. These people that are middle class in China have savings, they intend to save, and they want to invest. And that is going to be a key part of the future where the renminbi goes. So, the renminbi onshore versus offshore, in my mind, is just a construct to get them feeling, the authorities feeling safer and safer in mixing the two, just as South Africa and Belgium eventually did, and eventually led to an open capital account. So, what is the point of CNH and CNY? Well, you can see that the development of the CNH has been a steady and thoughtful inclusion of many, many countries. So originally, the only place that you could trade offshore renminbi was in Hong Kong. And then they included Singapore and London, and then they included Taiwan. Then they included New York, Canada, Switzerland, and now you can see that we've had a period of time where all the major financial centers in the world have the ability to trade the CNH. This is important because it led to the stability, allowing comfort on the Chinese side that the capital account porousness necessary to be included in the SDR and to move towards being a reserve currency was not going to destabilize the capital flows to the point where there was a crisis. The HIBOR rate is the way that this mechanism, the CNH, is controlled and monitored. And increasingly, it's clear that the authorities in China pay specific attention to the CNH rate as much as they look at the CNY rate against the dollar and against many of these currency pairs, which really makes it a far more complicated intervention game, which is important to those that trade for carry or other foreign exchange factors outside of politics or big macro thoughts. The outflow of capital is going to be monitored and viewed in the CNH lens. And that's a very important concept to grasp when we talk about what the CNH is and why it plays a role in CNY. As people raise capital in renminbi offshore, that is going to add comfort to allowing more porousness in the onshore. So one of these points that comes across is the dim sum bond market. It allows foreigners to basically invest in CNH assets. And that bond market started, basically in 2010 with Hong Kong, and it's become, bigger and bigger and more real. It's recently taken a little bit of dip because the devaluation of the renminbi against the dollar made the certainty that this was a no-brainer, i.e. you were issuing debt and the currency was going to continue to strengthen, less clear. Now, there's a couple of points to make about this. The offshore renminbi deposit market is far larger than any of the things that people can do with this CNH. And it makes clear that the banks are leaving money offshore, not reinvesting it onshore, partially because of fears of further devaluation, partially because they are thinking that there's going to be more and more demand for financing in the renminbi offshore, which I think is an accurate part of the overall picture and goal of the authorities to make the currency a real reserve currency, a real trade international settlement currency. I know I'm going very quickly. I hopefully haven't confused everyone here. So part and parcel of this CNH-CNY relationship is the SDR, which we mentioned before, but I think it's important to see and not overstate the role of the yuan in this marketplace. So it is the third currency. The dollar is, in the big scheme of things, is still 42% essentially. The euro's 31%, and the renminbi is 11% in the SDR. And then you have the Japanese yen and the British pound. This leaves clear that while China is terribly important to global trade, it is yet to be terribly important to global assets. And there's a lot of work to do to get the marketplace, both in stocks and bonds, more capital efficient and open to foreign investment flows in the same way that Japan and the British, or the which have far less smaller economies against that of China. So the role of the CNH in many ways is part and parcel of getting the percentage share of the SDR higher. And if we just stay where we are in this basis of where the offshore investors can put money into China with the RQF2, or that the number of deposits offshore remain higher than the bond markets, then this share of the SDR is actually going to have to go down in the next revisiting. And I don't think that's what the authorities want. So if anything, they want to be as big as the dollar, as big as the euro. And in order to get there, you're going to have to see the RQF relationships grow and the dim sum bonds market grow to make that a reality. Last question, and then I'll have time for hopefully some of your questions. So I probably made people more confused about what the renminbi is and whether it really is a asset reflection of value, a trade relationship, or something else. And I'll posit a couple of points here that really, right now, when you look at the renminbi and try to come up with what the factors are that drive value in this currency and its relationship to the euro, the yen, the dollar, even the ruble, it's about confidence, both onshore and offshore. The capital flight that has come from China that has led to the depletion of reserves, that has led to some of the rather erratic policy choices that happened over the last year, this has all stemmed from Chinese confidence. So the chart that I actually look at very closely comes from Market News International, one of my favorite small but very feisty news organizations. The China Consumer Sentiment Index that they have was now part of Westpac. They actually have this chart which you can get monthly. And if you compare the dollar relationship to this chart, you'll actually get a really solid view about how capital flight is partially measured by consumer confidence. It's said that China is a great place to make money and a horrible place to keep it. And until China changes that phrase, until it's also a good place to keep money, the capital flight pressures are going to continue to be there. The leadership change that's upcoming in China in October of next year is going to be an incredibly important part of this sentiment and a view of whether they're going to be able to cap the property market bubble or really help solve the non-performing loan problems in the banks. And those two things are dragging the consumer sentiment lower, along with the fact that GDP is just difficult to see growing when you're trying to shift the economy from an investment and industrial base to a service sector and consumer spending base. Perversely, if you want to make people feel rich and spend money, let's go back to one slide. What was the most important relationship for the Japanese Chinese? It was that the weakness of the yen led to Chinese tourism in Japan. If the authorities are not careful, the relationship of the dollar, the euro, and the yen to the renminbi, it has to be stable enough to continue to keep consumers confident enough that inflation's being held at bay and that they can go abroad and spend money safely. So Chinese tourism is another way of measuring Chinese FDI outflow. And that outflow is increasingly an important part of how to judge the success of the authorities in taking the demand of doubt and turning it into something that makes them feel that the outflow is for a good longer-term sustainable cause. The ability for the Chinese to buy companies in the US, in Europe, and in Asia may be a political one, but it's also part and parcel of how these currencies are stabilized. So I look at the Chinese outflow and I know that it's now almost the same as the Chinese inflow of capital from places like the West. So this balance is an important part of the larger picture. No country that is a reserve currency really can have a sustainably large current account surplus without significant political backlash and problems in the world community. One of the reasons why the euro has the problems it does is that it continues to be a current account surplus region, particularly in Germany, which is approaching 8% of current account surplus, which makes things far less stable, and which is one of the reasons why the Chinese were so willing to let the renminbi move and do some of these capital opening moves in 2008 to 2012. So I've thrown a lot at you there. The capital outflow story in China is partially a confidence game. It's partially by design, but it's an ongoing way of measuring whether we are going to see the renminbi go to 7 or stay here between 670 and 682 over the next 12 months. With $3 trillion of reserves and a trade surplus, the authorities feel pretty confident that they can stop any capital outflow, along with rather draconian measures to stop that. And they've been fairly successful in slowing the pace of reserve outflow. But as you can see from the chart on the right, there's still a lot going on. There is still a lot of foreign capital flow going out of China. And some of that is by design so that their companies can become more international, just like making the name WeChat as ubiquitous as Facebook, a tall order, or making Alibaba as important as Amazon to the West.
At your choice. Any points on this that you would like to comment on? If I could, let me introduce Peter. Peter is former head of the World Bank in China and professor at the School of Advanced International Studies at Johns Hopkins, and one of the best economists I certainly know on this subject. So Peter, give me your take.
Well, I'm very impressed, Malcolm, by Bob's presentation. The many questions. Let me just focus on one. I think Bob mentioned, and I believe correctly, that the Chinese would hate to see their share in the SDR decline from 10.8 or 10.9 at the present time. Yet, there are pressures going on, as Bob also mentioned, that would precisely do that. Now, my question is, in what way will the SDR inclusion therefore affect domestic economic, financial, exchange rate policies in China?
That is a very essential question, and I thank you, again for your flattering comments. I'm honored to have your praise. So the SDR onshore is going to have two effects. One, it makes the ability for the authorities to live with this kind of dollar volatility ongoing. It also means, so I don't expect this chart to go back to the quiet period of 2008 to 2011. It's just not, a dollar peg is gone. A dirty peg or its quiet appreciation is gone. What we're going to continue to see in China is an increasingly volatile reflection of both capital inflow and outflow, trade flows in inflow and outflow, and an increasing reflection of the internal inflation or deflation pressures on the currency. So I think what we're beginning to see, if they want to maintain 11% or so market share in the SDR, they're going to have to deal with increased volatility. They're going to have to see an incredibly focused path to including more assets available to foreigners to invest in China. So some of that is going to be the A shares being owned by foreigners, and increasing pressure on them to increase the RQF or come up with an entirely new regime to increase the size of Chinese assets that can be held abroad. And that makes, it basically, it puts the authorities in a increasingly difficult triangulation. The Holy Trinity of fixed currencies is lost. And the SDR is going to mean that they are going to be seeing increased foreign exchange volatility, not just against the dollar, but across all of their relationships. That's a long-winded answer, but one that may mean that they will find that their reserves that they have are less important than their political relationships in allowing asset negotiations and investments. This gets very complicated very fast for them.
Peter, what else?
Well, I'd like to leave the floor. I'm keen to hear other questions. This is such a complicated subject.
Yes, it is. Let me go with the questions. I've done my best to unmute you all. Is there anybody, Regis, trying to speak again? Somehow we're having a problem with the platform. I'll have to get with the service. Okay. Let me ask the questions that have been sent to me, and please write yours into the Q&A, and I will get to them. We have quite a number. For this, I have a question. Given the recent reports on the leadership succession, or lack thereof, for President Xi, is there a direction on this that favors his continuance or his keeping the two-term pattern? You have any thoughts on that, Bob?
Look, the speculation about Chinese politics is it makes the U.S. election look, like a child's play. they don't have polls that really capture the Politburo's internecine battles, but it seems to me that she is absolutely more powerful than almost any premier since Mao, and part of that was by design. The Communist Party wanted reform, and they got it. I think the idea that you're going to not see a two-term or a continuation of policy isn't my base case. I actually think that what she is looking for is someone to trust in fixing the economy. If there's one weakness in Xi, it's that he doesn't believe in markets, and he doesn't really understand any of the economic advisors that he's had in their lack of success, and therefore his level of trust for them. So I look at 2017 as a very big leadership change for the economic portfolio, if you will, in his cabinet, to make it all look and sound Western. And I think there will be some bumps and bruises out of that. Having said that, I'm an eternal optimist. I think that the Chinese run their country very well, and I would be foolhardy to think that Westerners like myself will ever know the internecine battles that are behind the scenes. I do think that we will have some island of stability about this far before October.
Peter, I'm going to not continue on this course. We only have a little bit of time. I'd love to get your views on this when we talk. The second question here is, what is the, and this is another, these are both political, that's why I kind of like them. What is the implied view of the Trump candidacy in this analysis? Said another way, how much of a shock and in which direction would a Trump victory be to these exchange rates?
That's not my base case, and I'm not a politician. The market odds of Trump winning are still uncomfortably small, but I don't think that we should be thinking that that's the base case. But on the tail risk of that happening, if Trump actually does rejigger trade relationships or put up a embargo against U.S. Imports from China, there's going to be a couple of things that happen almost immediately. A significant rise in prices across the board in a lot of consumer goods in the U.S. leads immediately to inflation and very angry voters. I think that the backlash against that, where most U.S. international companies have very strong trade relationships with China, Apple being, an obvious one, where the iPhone cost would suddenly zoom to probably 2,000 instead of the rather quiet 800, and the idea that you're going to have a 100% increase in electronic goods or some industrial goods is pretty terrifying. I think the other point would be, again, geopolitical, which is the relationship of the U.S. to Asia. The Obama pivot to Asia out of the Middle East was going to be, the crowning jewel of his administration. And I think it's going to be one of the things that really is under focus in that whoever wins the next election. I think Clinton or Trump are going to face a very difficult time in convincing Asian partners like Japan, Korea, Thailand, the Philippines, to increasingly toe the line on Chinese relationships and pressure for Chinese reform. That just ain't going to happen. And if Trump is too extreme in his approach, I think the backlash against the United States globally will be painful and lead to a smaller U.S. Global trade relationship.
We're running out of time, so I'm going to move on to the next one here. Does the lower Fed terminal rate take a big risk off the table from an FX management standpoint? It seems like it should.
Well, lower for longer has other problems. Lower for longer increases the risk of the tail inflation risk. It increases the pressure on savers. And let's be clear, China is a saver more than it is a borrower. So they have a non-performing loan problem because they also have a savings glut that can't be expressed in normal channels. So they have a property bubble, and you had a stock market bubble, and you've had increasing commodity bubbles that have come out of their capital control environment. It seems to me that the lower for longer problem in the US means that there's less likelihood that some of the Chinese capital that was easy to keep here in the halcyon days pre-2008 when bond yields were 4 or 5%, that has gone. And it makes the world far more complicated for savers to find a safe home. It does relieve pressure on the renminbi and the appreciation game. But it does make the Chinese yuan, Chinese yen relationships that much more complicated. So it isn't a panacea. And it also opens up, as I said before, the world to a future inflation spike that will test the ability of central banks to remain credible and actually stay ahead of the inflation curve 5-10 years from now.
Peter, can I put that same question to you? Peter?
I'm sorry, I was distracted.
That's okay. Let me give it to you again. Does the lower Fed terminal rate take a big risk off the table from an FX management standpoint?
Well, that's impossible to answer in a few minutes, or even in 10 or 20 minutes. The monetary policy situation globally is so complicated at the moment, and I'm the last one who really knows how to answer that question. I think the recent decision by the Fed to stabilize the situation at least until December will probably suit the Chinese, but the inevitability of increases at some point is the overriding issue. And how that plays out in the Chinese foreign policy and Chinese foreign exchange management and exchange rate management, I honestly don't know.
Well, I should say that one of the reasons why Peter is the most favorite of all our speakers is his willingness to say, I don't know, when he doesn't know. And in a world of pundits and of people who are convinced of the rightness of their point of view, it's wonderful to hear that. Okay, next question. Please explain more how China can maintain a firewall between the CNH and the CNY.
I think it can't if it wants to maintain its SDR share. Over time, it's just going to get more and more porous. And I think that they're actively trying to make clear that they can intervene in both. So I think it's going to be increasingly porous, but increasingly clear to players that are trying to destabilize in their minds or play for arbitrage that that's not necessarily a free lunch. And that's the best I got.
Okay, that sounds good. Peter, any thoughts?
I think the CNH, CNY exchange rate differential is the Achilles heel of the whole system. As Bob was pointing out, this is not consistent with China's objective of an open capital account. And ultimately, it cannot last. Something will have to give. I think the financial authorities will try to open the capital account as far as they can, as far as the political authorities will allow them to, in order partly to depress the differential between the CNH and the CNY. But again, this is such a hugely complicated subject. You cannot possibly exhaust it in a few minutes. But as I said, the exchange rate differential between the two is due to the partial closure of China's capital account. If you were to open the capital account totally tomorrow, that differential would disappear. And the whole rationale for the CNH would in fact disappear.
Well, We are just about at the end of our hour. Bob, would you please give some closing thoughts? And I apologize for not getting to everyone's questions. If you still have pressing questions, please email them to me and we'll do our best to answer them. Bob?
Sure. Thank you. I think currency trading is increasingly very short term. And the relationship of holding a position in a currency, whether it's CNH or euro or yen, has become seconds or minutes rather than days and months and years. So it's a pleasure to talk longer term about the future of the renminbi. And when you think about the renminbi, you have to think in the Chinese construct of short term to them is actually a year or two. Medium term is a decade. Long term is 100 years or more. So I think to understand the problem of trading this currency pair is that the authorities are getting hit wave upon wave with outside crisis capital flows and flight that really hit at the confidence of the people themselves and the assets that they hold. And the ability for the Chinese to, just like any other major country, financial conditions and financial stability is going to be increasingly difficult to hold together, particularly if we see bigger and bigger political shifts, whether that's in Europe or in the United States or in China itself. Particularly if we see continued monetary policy divergence from the Fed to the BOJ to the ECB. And I think that the only certainty that I have about the renminbi is that it's going to be increasingly volatile, and that the authorities will try their best to make it a haven, just like the British pound or the yen or the euro against the dollar at certain periods of time.
Thank you. Peter, how about you? Anything you'd like to?
Well, I totally agree with that. I'm also very full of trepidation about forecasts, but I think Bob's characterization of the key issue, the probability of increased volatility, I totally agree with. I think ultimately the very existence of the CNH is inconsistent with China's objective of being a reserve currency. So if they want to be a haven currency, dollar-style haven currency, they will totally have to open the capital account, which politically is not possible in China at this point.